Foreclosures are on the rise again, and we're going to talk about that today and how it compares to 2019 and if you should be concerned.
Well, here we go.
Yeah, so after years of historically low foreclosures because of pandemic forbearance and stimulus, we are definitely seeing a rise in foreclosure activity.
Yeah. It's not something that we should be like freaking out about yet, but it's definitely moving the wrong direction. Right. And that, you know, what happens with everything is it starts off slow and then all at once. Right. That is normal.
Yeah. And right now we're seeing 17% year over year increase in foreclosures. And just in October alone, it went up to 19% year over year.
Okay,
So it is ticking up
that's a lot.
for sure.
20%, almost 20%.
Well, increase.
Yeah. Right. Still, like that's a fair amount. Right. These are not small increments. Sometimes you see these. You see people make these assumptions based on something moving like 1/10 of a percentage point or something. But 20% year over year is something to watch.
Yeah, and if you look in 2019, you had monthly filings from like 40 to 45,000 a month. Right now, we're at 36,000 a month. So we are still lower than 2019, but with the rate of increase, it is a bit concerning, as we move closer to those numbers.
What do you think? What do you think is the reason? Like, what do you think's happening right now?
Well, I think right now what you have that you didn't have in 2019 is inflation and such a squeezed economy. And we're going to be talking about this on our show, on our podcast on Thursday. But, Americans are dealing with a lot of affordability issues right now. Wages have not kept up with inflation in general. And so I think that is going to be a big issue,
right?
Moving forward.
Oh, without a doubt. I mean, it's affecting everybody right now, right? It's the number one thing on the table. It's something that everybody's discussing, whether it's fuel. We're heading into this interesting time, but gas is up, fuel prices are up. Obviously, they're down from where they were, but they're certainly, it's still very, very expensive. Rent is up, but it's also coming down a little bit, and also food is up, right? Those are some of the main staples that people deal with right now.
Yeah, and you're seeing that too in the car repo market as well. Things that people need and have to have are, getting increasingly expensive. And something I thought was interesting is we were watching Sunday Morning yesterday, and, people are paying more to stay in these weekly extended stays than they were for rent. And they're also paying weekly on some of these cars, versus monthly, and it's more expensive. And what I think part of that is, when you have to pay for something weekly, it makes you kind of have to budget for it, even if it's more, because it's due every,
well,
Friday.
It showed you where everybody was, like that documentary, I guess, or segment. Essentially, people were paying like $500-$600 a week, right, for a family, right, in these extended cares, which is
extended stays.
So. And they were saying that those are essentially almost twice what rent would be, right? But they're kind of caught in this loop, right?
Yep.
And so you'll think about all the things that they have, from a moving cost to the utilities, and maybe even furniture in some cases. So it was a very, very, very eye-opening piece, and I think. It's something that we should be continuing to watch.
Yeah, and I think the people that are most vulnerable are those that have got a loan that were, 2023 and after, because right now you have about 80% of rates below 4 or paid off. And then you have that 20% of people that are in these high interest loans. And from what I'm seeing on, the ground where I'm at, is a lot of these foreclosures are from the last couple of years, or people that are highly leveraged, on their debt. Because at the end of the day, you wouldn't foreclose if you didn't have much of a balance. You would just sell and make your profit. So it's people that refinanced at these higher rates, or people that bought at these higher rates.
Yeah, it definitely could be. I also think that, you look at personal savings rates are way down. So they went way up when everybody got their stimmy checks, and that money's gone, and then now you're seeing credit card debt going to all-time highs. So you have two things going the wrong direction. One, you've got very, very expensive debt going up. People, because their habits didn't change in a lot of cases. A lot of people did, but that's bad. And then cash, and I think that the economy is not free flowing with cash like it used to be. Like, think of, things are getting kind of managed and buttoned up. Right now I like to talk about these Uber drivers and Uber Eats and DoorDash and all these kinds of folks. That's all certainly in a lot of areas becoming automated, right? Mm-hmm. I mean, in Phoenix, for example, you get DoorDash you can get the food through Waymo, right? And they just put it in there and it comes over.
Yeah.
It's like there's this automation, this AI, obviously, and then it's also affecting, I think, people are getting squeezed in, so they're spending less, right? Like, we're heading to Vegas today, for example, and Vegas right now is down, right? Mm-hmm. Okay, so not that that's the barometer that we should all be watching, but it's something that we should take note of, and that is, when do people stop going to Vegas? They stop going to Vegas when things get tight. And because Vegas is something that you're just going to go spend a bunch of money and you're going to fly back or drive back or whatever, and with less, right? And so, that's changing. And I lived in Vegas years ago, and I used to see that happening firsthand. And so when you start to see room rates down, the occupancy is really, really, really down, then they start to do promotions. They start to promote Vegas. And again, I don't want to just pound down here on Vegas, but the point is that there are, when that happens, the service sector gets affected, is my point. So what gets affected? Everybody that services that sector gets affected. And so it's so visual to see in Vegas, and it's not as easy to look at a city. But
I'm going to just disagree with you, because I think that this is a bigger issue than people going on vacation. That's kind of what a normal recession is when people have to cut back on, vacation. But this inflation has made it so people aren't even thinking about vacation. They're more focused on food, groceries. And as we talked about, it's this K-shaped economy, right? And consumer spending is still up because the boomers have money and they can spend money and they can go on vacation and they can do all this. But your Gen Z and your millennials, especially those that don't own homes or have very high mortgage payments, they're very squeezed right now. And so now it's becoming more, and that's why you see people losing their cars, and that's why you see people losing their houses, because realistically, I mean, people would almost lose a house before they would lose a car in a lot of situations, because your car you can live in, you can drive, you need to get to go to work. Like, you can't lose your car and then keep your house, because how are you getting to work, and how are you paying for things? So, when you see this uptick in repo market, I think you really have to look at how that's going to affect the foreclosure market as well. But then you also have people with very, very low payments and that aren't stressed at all about their house because they have a 3% mortgage and they bought it forever ago and they didn't spend a lot of money on it. So you have those people as well. And I do think in the foreclosures, though, you have to look at who's foreclosing. And I think a lot of foreclosures are flippers because they're in very expensive mortgages and they hard money and they can't get out of it. And then I also think somebody on the live brought up Airbnbs, right? Because I know a lot of people bought Airbnbs for very high prices on very high mortgage rates because they were making $13,000, $15,000 a month. And now with the increase in hold on, we have a landscaper out there. Jerry, can you go tell him? The increase in people doing that, then it's not going to be the same, kind of level. Sorry, guys. We have somebody blowing leaves outside the studio door.
That's awesome. But back to the Vegas thing. I just want to make a point. My point is not that people aren't getting stressed. When there's money stress, they stop doing stuff. They stop spending. They stop going on travel. They start to look at their finances a little bit more. And that's my point. And that is the first thing that you do when you start to look at foreclosures, right? I mean, for sure, right? Let's don't forget, there's a process when people, they don't actually pay their mortgage, right? There's a process. So the first one is they miss it. Then they get a notice, and then they miss the second one, right? And now they're in on the default list, right? And so there's a process here that takes months, and that's my point. And I think that's bigger. And the reason why I brought up Vegas is because it's so apparent. It's one of those cities where you can see tourism, like it's a very visual thing, right? People going, the room rates, and it's harder to measure in other areas. That's all.
Yeah, it's definitely going to be interesting moving forward. Now, we've had time periods where we've had foreclosures tick up, and foreclosures ticking up does not mean that the housing market is crashing. Once again, it's an indicator that there's some issues in the affordability of the housing market. But you do have to remember that most of these people that are in very solid low rate loans probably are going to be able to afford to keep those loans.
Yeah, I think I would, and obviously that to your point, we don't know the data behind that. If you've got a 3% loan or a 6% loan or a 7% loan, we don't know, right? I mean, we could dig into that. It's not a bad thing to look at.
No, but Josh just commented on YouTube that, he's a commercial appraiser in Florida, and nightly rental properties are getting killed. And that is something we're seeing across the board. We're seeing these Airbnb properties listed. Those that listed, last year probably doing better than this year, but they bought for a lot of money, and they're in high rate loans. Once
again, if Airbnb is getting pounded, hotels are getting pounded. Again, same thing. Nightly rentals. That's what Vegas is. It's a nightly rental city. So, it hit a while ago. It hit almost a year ago.
Yeah, and we're talking about, we've mentioned before, what Trump wants to do to try to make these products, make the housing market more affordable. But, really it's the affordability of the whole economy right now that we're seeing issues on. And like I said, on our podcast on Thursday, we're going to be chatting about what the administration is currently doing to help with affordability in general, because this isn't really just like a housing issue. Like 2008 was a housing issue because you had people in these low rate mortgages, and they were adjustable, and they adjusted to rates that were really high and people couldn't afford them. Well, that's not the issue now. The issue now is the HOA is up, the taxes is up, the insurance is up, the cars, fixing the cars more expensive, groceries are more expensive, gas, daycare. So people are just getting squeezed out of all these other things, and they don't have the money they once had to pay their mortgage. And, your car and your mortgage are the last two things people won't pay. So if those are not getting paid, you do have to look at that.
Yeah, and there's talk about whether or not the Fed's going to lower rates at all in December, and I know. Well, let's just put it. The committee, I think, is made of 13 people. They're kind of neutral right now on that issue, and so I think that that's something that would give immediate relief. But I don't see that coming, because when you've got a little tick up in unemployment right now, maybe that's seasonal, but you also got a little bit of tick up in uptick in inflation. The Fed's we're not going to see, I believe, in 26 these deep rate decreases. I mean, everybody thought that was going to happen in 25, right? Let's don't forget, at the beginning of 25, everybody's like, "Oh, rates are going down." Well, they did a little bit, but not meaningful. And I think you're not going to see the deep cuts. We're not in that kind of a situation, and so there's not really going to be any real relief, And I think that what we're starting to see is other things jump, like gold and silver, for example. Silver was over $50 an ounce. Robert Kiyosaki sent me this video over the weekend. He said, check this out, we're at 50. And of course, gold, which is a perfect segue to our new sponsor, Monetary Metals. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
We also have to talk about the equity erosion, because that is part of the foreclosure situation, right? So when things constantly have went up from 2020 to probably 2023, you're not going to have foreclosures if everything you buy is going up. And that's kind of what happened in '08, is when things stopped going up is when there was a problem, right? So right now, we're not seeing a crashing of the market, but there's been some softening, so for those that bought in 23 and 24, trying to sell now in 25, even if you just have a minor decrease in prices, depending on what your down payment was, you might be underwater, and that's part of the reason people are having to foreclose.
Yeah, in 2008, which I went through, was extremely different. And the difference, of course, was that the values of the homes were below the loan. That's the difference. And so right now, the good thing is we've got all this massive equity, right? Mm-hmm. But to your point, depending on when you bought or refinanced, right? Even Ross and I, we had stuff that we owned a long time, and we refinanced, and all of a sudden, we were doing a cash out refi, but we were also doing renovations, and all of a sudden the rate jumped on us, right?
Yeah.
We're like, uh-oh. We did not anticipate the rate going up like this, and luckily these were properties we owned a long time, and so we had to take action, like either do a cash in refi, back to lock it back in, or in some cases we even sold some assets. So this is the other side of it that a lot of people don't talk about, right?
Yeah. And, people don't have a savings cushion right now. And that's a big deal, too, because, when you're living paycheck to paycheck, everything's fine when you're living paycheck to paycheck until you have something happen with your home, or you have something happen with your health, or something big where you need money and you don't have it, and we see some of this stuff, with in the Phoenix area, when the home needs a lot of repair and you can't afford to repair it. And these kind of things are what make people foreclose. You can't sell it for what you paid for it, and there's a lot of work that needs done on it that you can't afford, or you lose your job because the job market's not that great right now. There's a lot of things that can just push you over the edge where you can't afford to make those payments any longer.
Yeah. I mean, at the end of the day, if you have a bunch of equity, you're probably not going to foreclose, right?
Right.
So we're talking about a smaller percentage of people that came in late in the Airbnb market, in the flipper market, or maybe they just bought a home. As you guys know, home prices actually did go up a little bit, like between 1% and 2%. Nationally, but not everywhere.
And that's why a lot of these foreclosures are happening in Florida is a big hotspot for this. Illinois is a big hotspot for this. So markets that are taking more of a hit than other markets obviously are going to have more foreclosures.
Yeah, and it's just like anything. Austin's another one. The hottest markets are the ones that retract the fastest too.
Yep.
So,
yep.
And that's what you're starting to see. But it is an interesting thing to watch, because the question is how far is this going to go, right?
Yeah, it's something that we have to keep an eye on. It's not an emergency or anything that you need to freak out about right now. But if it continues to uptick, that is when, you're going to be more concerned.
Yeah, and also that does mean good deals out there for some folks, right? Like it's interesting because everybody wants affordability. Which actually what that means is they want prices to come down.
Right.
Or they want interest rates to come down. Well, I don't think you're going to get the interest rate gift that we had for some time, certainly not through next year. based on the fundamentals of the economy. So therefore, then it has to be the value of the house. Well, if that does happen, if home prices come back from, let's say, back under 400, people are going to be screaming, right? So you got to pick a lane. What lane do you want to be in? You want to be in I want affordability. I want the houses to come down in price, or I want the interest rates. The interest rate's a little more complicated.
So let's first talk about why this is not 2008. And one of the biggest things is almost all the loans today are of a fixed rate, and people can afford that rate. The second thing is underwriting was a lot stronger, and most people have more money down than the 0% loans back in 2008.
Yeah, there's the one thing that tipped the market in 08, because I was there, was the home was worth less than the loan, period. The rate was important, don't get me wrong, but the home was, who cares about the rate if the home's worth less than you know what I mean? I mean, I guess if you have a payment, right? But if you're sitting there, if you put down 20% and all of a sudden your home is worth negative 20%, you've lost 40%. You've lost a shit ton of money, right? So you're sitting there going, okay, why would I want to sit in an asset that's not worth, I can't sell it. I have to write a check to sell it. So what they did is they defaulted. So the rate was important, but not that important, because it'd be like, you're underwater essentially. And so the question, they just made a decision. Do I, let's say my mortgage payment was $3,000. And I'm 200,000 underwater or 100,000 underwater. Just pick something. It doesn't really matter. If I can move to a rental for 1,500, I'm better off. The question is do I want to foreclose, right? Do I want to be foreclosed on?
But I think there's more to it than that. Because I think in 08, most people didn't have any money down. So it's very easy to walk away from something when you put no money into it. It's a lot harder when you have a down payment. Like I just spoke to a client a few weeks ago, and she's in a situation where, they have to move. Her husband's in the military. The house is not worth what they bought it for. And I'm chatting with her, and they have 0% down, because on VA loans, you don't have to put money down.
Yeah, it's an excellent point.
And they've only been there 2 years. So, she's freaking out, and I'm like, just walk away from it, because it's going to mess up your credit for, 7 years or whatever it is. But at the end of the day, you don't have any money down. You can't afford to keep it. You're going to sell it for a loss, right? But if she would have had 20% down, for one, it wouldn't have been a loss if she would have put 20% down. But two, even if she put 10% down, it's a harder decision, because now, you've put down all this money. You know what I mean? It's easy to walk away from something when you have nothing invested into it but a monthly payment. So, when people have to put money down, and a lot of these people did, then you don't want to foreclose as fast. And if you really look at the numbers, and I don't have the exact, most of the foreclosures even now are FHA. And FHA loans, you have to put a lot less down than a conventional loan. And so that is the reason it's easier for people to walk away from.
That's interesting. Yeah, well, I agree with that, actually. I think, if you have zero in and the thing goes down, a lot of people walk. Right. Yeah. And so that is a good point. And some people will hang on for that cash, even though it's gone. It's the same problem. It just depends on whose money it is.
Yeah.
It's either the bank's or it's yours. So either way, you're underwater, right? The situation doesn't change where you're underneath the loan.
Yep. And then the other thing right now that we don't have yet is we don't have unemployment is not spiking. Unemployment is still good. Now, I know that those listening, the numbers are going up, and that's something else we have to watch. I think the biggest things to watch right now over the next, 6 or 12 months is foreclosure rates and unemployment rates, because that's going to drive everything. Because what you don't have right now is you don't have a wave of subprime adjustable rate mortgages hitting like in 2008 that crashed the market. You have unemployment and foreclosures, because that's affordability. So those are the two metrics that you really need to be paying attention to.
But the one thing that I would watch is unemployment is and can be a leading indicator to default, right? Obviously, right? When depending on the situation they're in, right? If they don't have any savings at all, and they become unemployed, then it's significantly worse if they don't have any safety nets. If they do, of course, you won't see that, right? They'll figure it out.
Yeah, and so just because we're saying you don't worry about this yet, the warning signs here are real. You have defaults are starting to rise. That is always the first domino in a softening or potential crash of a housing market. And equity cushions are shrinking. So as you see prices kind of soften, those equity cushions is what creates foreclosures from not happening. So if people are losing their equity, then that is obviously going to fuel more foreclosures.
Right. And right. But again, I do think it's a small percentage of the market because there's a tremendous amount of people that are under 4% fixed.
Yeah.
Right.
And they can very much afford their houses. That's the thing too. Like my brother could afford a nicer house. He just doesn't want to pay the additional cost. But because of that, he's staying in place. And because he's continued to make those payments, has more equity and also in a very affordable monthly payment for him.
Yeah.
So, you have to look at that. Like my brother's not going to sell his house or have to foreclose because he didn't, the American way is like always maximizing your spending, but a lot of these people can't because they can't move into that next threshold. So as they're stagnant there, they're actually in a much more comfortable financial place too.
Right. That's precisely what Trump's trying to unlock. By beating on the Fed when money moves, there's velocity to money. And when it moves from like Danielle's situation where she's got that few $100,000 of equity, it moves. It starts to move. It moves to another asset. It moves into stocks. It moves into T-bills. It moves into index funds. It moves into whatever. And then people make fees on that, right? So maybe they're realtor fees or maybe they're mortgage fees or title fees, and maybe she's buying property management fees. So when the economy gets unlocked with low rates, for sure. People do stuff, right? They buy houses, they buy cars, they buy electronics, and things do change. And so that's what he's trying to do. There's a tremendous amount of money. I think, gosh, I don't want to guess, but I know is it over 10 trillion? Actually, it might be even significantly more of actual equity sitting in people's homes. It is a big number, and so that's what they're trying to get at, right?
Yeah, and I do think it's going to be interesting. And Ibu brought up something on YouTube, as he said, but if the unemployment numbers start to go down, they're going to cut rates, drastically.
Yeah.
So
he's right.
Yeah. So I mean, you always have to look at all these different things, and then people that are in these higher rates can refinance potentially to lower rates and then stay in their homes too. Because part of the issue is the high rates, right? If people could refinance into the rates that other people have, 2020, 2021. Yeah. Their payment would be significantly less, and they could maybe afford to keep their home.
The real issue is going to be like in Florida, where there's a tremendous amount of people there that paid at the top of the market, and there are those same homes are worth less. Okay, They're trapped. So that's not systemic across the country. Okay, there are micro areas, of course. But there are areas like that where there were super hot Austins like that, where people are looking at. I was talking to Tarl last week. Tarl's actually my partner in Limitless Expo, which we do once a year. This year it's in Scottsdale, and he's starting to buy in Austin right now, and because of the collateral damage that happened as a result, right? So there are really, really good markets to take a look at. Now, the question is are you catching a falling knife? Does it keep going? And you got to have the cash for that, right? You have to have the stomach to be able to, hold that to that point. That's why I love cash flowing real estate. I mean, I don't have the stomach to be able to buy a home today and know whether it's going to go up or down at all, right? I'd rather do the forced equity model, which is what we do with apartments, right? It's just, it comes with a bunch of people in it, and then I have more options.
Yep. And you're going to see this most in entry-level housing. and also in the high FHA areas, and we're seeing that already in the high FHA areas. You're going to see more foreclosures there because they're more strapped. They didn't put as much down. It's just a different, just kind of like on the Class C apartments, we saw more issues during COVID, with the payments. Same thing with this. It's the more affordable housing is going to get hit the hardest. So we will see, and we'll see you guys next week.
Guys, enjoy your week.